The market value of Tisland was $60 million on January 1st. During the year, $30 million is to be raised to invest in new projects. The firm's capital structure is debt $30 million, equity $30 million, for a total of $60 million. Clearly, we can identify that the firm has 50% debt and 50% equity. New bonds will have a coupon of 8% sold at par. Common equity is selling at $30 per share, and the required rate of return is 12%. That 12% is composed of a 4% dividend yield and expected growth of 8%. The next dividend should be $1.20. The marginal tax rate is 40%. To maintain the current capital structure, how much of the new investment must be financed by equity? So $30 million is to be raised, and we can clearly see that the debt is 50% and the equity is 50% of the capital structure. So if $30 million is to be raised and half of it is to be equity, $15 million will need to be raised equity and $15 million in debt. In part B, if there is sufficient cash flow to maintain the current capital structure without issuing shares, what is the Wacc? So the way to interpret this is there is sufficient cash flow. They don't need to add any new equity or debt. We can just simply say is equal to debt or equity of 50% times the cost of equity, 12%, plus the weight of debt times the cost of debt times 1 minus the tax rate. Wacc for Tisland is, or the post-tax Wacc to be specific, is 8.4%. If there's not sufficient cash flow and equity will need to be issued, what will happen to the Wacc? Well, obviously, the required return on equity is 12%. That's much greater than 8.4%. So if we have to issue equity, that is delever the firm, the cost of capital will increase. So we'll see the Wacc increase from 8.4 towards 12%.